Hello everyone, and welcome to Tuesday, June 25th's mentorship webinar. Very cool stuff. The market is just going up and down and up and down and up and down. And what direction is it going in? Well, it's going down. It's obviously going down. How far is it going to go down? I can show you some projections on the Fibonacci extensions, but you know, that's about the best I can do. I think we're in excellent position to take advantage of everything that's going on. Let's take a look at the chart of the Dow here. Well, what I want to do is blow this up a little bit. I'm going to go to maximize sell, and I'm going to blow this up one more level, because what I want to do is we had a measured move way back when it went from this high to this low to this lower high right here. Then later on we had a bigger measured move that went from here to here, up to here, and finally was confirmed when it went below that point towards the end of the day. Okay, let's do some Fibonacci's. Let's put up the fib extension, and if we go from this high to this low, remember we're going all the way to the bottom of the wick, and we're coming up here right to there. Okay, you can see yesterday what happened. Yesterday we had a big down day. A lot of panic in the market. The Japanese market was low. The Nikkei was low. Then it came across to the DAX, the German DAX, and the FTSE. They were all extremely low. And our market opened up, and we were down, you know, close to 250 points at one point in time. Then towards the end of the day, cooler heads prevailed, and then the market only closed about 100 points down. Well, what was that? That was a reaction to, okay, we've had too big of a drop, and you know, I'm going to take some profits here if I'm on the short side, and that would be greed. And then we had fear, because those of us that might have been long are like, oh wow, you know, I better get out. So fear and greed were going on yesterday, and it came down, and let's see, the 261.8 Fibonacci was at the 14,561. 14,561, and the low yesterday was 14,551. Is that uncanny or what? Came down, hit it, and moved back up. Closed a little bit lower, and today we're up 82 points today on a little bit of a recovery. And this is the way the market trades. Okay, so we're still on a downtrend. We're still on a downtrend on the Dow, because, you know, it made its first measured move, confirmation right here. Then it made its second one right here. So the classic definition of trend, a downtrend, is lower lows with lower highs. Okay, comes down here, makes a lower high, then confirms with a lower low. Okay, comes down here and comes up here with a lower high, and then lower low. Okay, and that's the classic definition of trend. So we are still in a downtrend. Now, is this catastrophic? As I see it right now, no. And if we look at the RUT, I'm gonna go back to let's go back to look at the whole thing here. Yeah, let's go into the RUT. There you go. Okay. If we look at the RUT, similar things happened to the RUT. We had drawn this Fibonacci extension way back in, you can see it confirmed here way back in the 1st of June, June 5th. We said, hey, the trend is probably changing according to this measured move to the downside. Okay. Have we gone above this previous high? No. No. Okay. Have we made a new lower low? Yes. Are we in a downtrend on the RUT? Yes. Yes, we are. Yes, we are. That first Fibonacci extension, here's the 161.8 right here. Okay. And that was at 943.49. Yesterday's low on the RUT was 942.79. Pretty awesome. Pretty awesome. Okay, so how do I look at this? For the RUT trade, I went along with what David said the other day, which I thought was excellent, and that was, the market's going down. We had whoosh, whoosh, whoosh. Made sense to get out of the bear call side of our RUT. This guy up here. Because it was originally worth 90 cents and it went, well, actually, I'm sorry, it was worth 80 cents. It was worth 80 cents when I got it. And it was then worth 10 cents. So just like I said on the blog last night, let's go ahead, or the night before, let's go ahead and get out of that. And David, I think that was an excellent call. It's an excellent call. The thing is, if you look, we've got 23 days. 23 days to go here. And you've got, it went from 80 down to a dime. So you made 70 cents on 80 cents, or you made very close to 90% of the total amount you could make. And you've got 23 days to go here. Wow, that's a huge amount of risk for very, very little gain. Now, I know a lot of people will just say, I can't be bothered. I'm just going to let it expire worthless. And more power to them. I don't trade that way. I can't trade that way. I'd be like, wait a second, what am I doing here? I've got 23 days. I know a lot can happen in 23 days. Here's 23 days right here, and where it went from 900 to 1,000. Okay, did we forget about that so soon? It was only 2 months ago. That was a 100-point move in about the time frame we're looking. Okay. That's that would take it right up to here. Whoa. Wow. So we would be in a hurting position there. We would be losing a lot of money there, because if you look at the Analyze tab, you're beyond that shoulder. You're down here, and holy smokes, that's the kind of risk you have. 10 contracts, you've got potential of losing $8,300. $8,300. That's your risk. And the gain is 100. 10 cents times the 100 contracts times the 10 contracts if you've got 10. So the risk reward of holding on to that just did not make sense. Just did not make sense. So I got out of there. I got out of there. So basically, right now, what we have is the bull put. And the bull put is how we started this trade. Okay. The bull put we got in at 90 cents. We got it at 90 cents. And it currently is at $1.20. So we've lost some money on that one. But we made, on 10 contracts, we made $700 on our bear call, and we're out of it. Okay, so we made $700. Now, if remember, I'm getting some readings up here that my audio connection has been lost. Is anybody else? Are you hearing me okay? Hello. Well, I just got a word there that it's reconnecting to my audio. And Jim, you are my main man here, so I'm going to unmute you. Oops, I can't even do that. So something must be, I must have lost the connection. Hang in there, guys. Jim, I think I lost the audio for a while. Is that, you confirm that?
That's what I'm confirming.
Yeah, okay. All right. Well, you remember where I was at?
I do. Actually, we were just talking about dropping out of the bear call.
Okay, okay. Excellent.
And that's where I lost the audio.
Okay, okay. All right. I'm back. Sorry about that. Yeah, and dropping out of the bear call, we made $700 profit on that. Okay, so you know, if we look at the risk profile for the iron condor, we're always looking to the uncle point, if you will, not necessarily the exit, but the uncle point is right around the 6% or $600. Okay, so we've already made 700 on the bear call. I'm willing to lose 6% on the total trade. So in a sense, I'm willing to lose 1,300 on our bull put. Make sense? Okay. So if we look at that and we just look at the bull put now, we're down a little bit on the bull put, but we can go all the way out to 935, which is you know, 25 points away, and we're still okay. Well, where is that? I think I'm back. I saw it this time, and I think it's something with going on with Citrix, and it keeps dropping me like that. So I'll keep an eye on that. But where I was talking is that really I'm willing to risk 1,300 on the bull put side. So we've got quite a ways to go. If you look at the chart, that's where the new uncle point would be, if you will. And the thing is, where we are now, there is a boatload of support. I mean, if we put some more time on this, let me go to the 6 months daily. You can see that this area where we are now. It came up and it consolidated there, dropped down, came up, dropped down, came up, dropped down 4 times. It tried to break through there. It finally did, and now it's coming down. That's a boatload of support there. So I'm okay letting this trade go on the bull put side. I'm okay. And we'll see, but we'll continue to watch it. But as of right now, I'm comfortable with what we've got. All right. Okay. Let me just scan through here real quick and see. SD, I see you have your hand up. Let me unmute you. Question.
Good morning, or good afternoon by you.
Yes, it is.
Dale, could you go back to the Dow Jones, the DJI chart that you had up a moment ago?
Absolutely.
Yeah, and to pull up that one grid that you had open.
That one?
And hand G on that, the June, like maybe June the 5th.
One more time, SD, because you were breaking up as you were coming through. One more time.
Oh, sorry.
No problem.
I wanted you to point to the hammer-like doji on June the 5th. Go back. Right, one more. Next one, there.
This
now,
one?
are you taking the measured move from there, from the high of 15,542 down to? I mean, is that you were using that other candle as a measured move, and I'm wondering, doesn't that make more sense to use that candle as a measured move for the Dow?
Yes. There's two measured moves that I can use here. One is this first one that comes down and confirms right here.
Because that's a swing low. Is that why it confirms?
That is correct. It's a lower high and then a lower low.
Okay.
Now, then it continues down here and makes a low here, but it retraces back up to this point, which is also a lower high, and then it confirms with another lower low. But the wick of this candle is most definitely, the confirmation was right here on this bearish day.
Okay, so are you going to use that now as further framework for the Dow possibly retracing?
Yes. They build on one another, if you will, and that's an interesting point. And I'm going to be talking about that a little bit later because I want to talk a little bit about measured moves. But basically, what we can do is we can do the first Fibonacci that we see. Okay, and then I'm going to take out everything but that 261. Okay, then what you can do is you can either go from this high to this low and back up, or you can go from this high, because this is now the dominant measured move. So the lower percentages will have more credence. So I'm going to go from this high down to here and then back up. And what you want to see there is, with the dominant measured move, the 78.6 and the 100 really come into play. And you can see that the 100 and the 261 are clustered together, and that's what you want to see. So they're building on one another.
Okay, so that leads into my other question, and I know you're not in the recommendation business, but you have, well, my wife has a small 401k at the hospital, choices, so it's, I think we have an S&P option and a NASDAQ option and that kind of thing. And in hindsight, I probably should have gone to cash a couple of days ago. I'm hoping for which like I got today, but I certainly brought this thing all the way down either.
Okay, I didn't fully hear you because it was breaking up a little bit, but I think what I understood is that you have you're in some long positions and you're wondering whether or not you should get out of those long positions and get into cash, basically.
Well, actually, the long position, it's in a 401k. It's in,
right.
They don't give you that many options, at least where my wife works, and
yes.
so I just have it in S&P. It tracks the S&P. I should have gotten out a days ago. Now I was.
Yeah, SD, you're breaking up.
For a more favorable.
Yeah, you're breaking up a lot. Let me see if I can answer that by just not fully understanding what you were saying here. But as soon as you get a measured move in the opposite direction, that's basically saying the trend has changed. That's the time you want to jump out of any long positions for sure. Now, at this point in time, this has been a pretty big move down. Whether it's going to sit here and consolidate for a while or whether it's going to go further down, it could go further down, absolutely. But probably it will either consolidate here a little bit or maybe go up a little bit if it is going to make another leg to the downside. But, it's a little late to, I'd almost be afraid to jump out of long positions at this point in time because who knows, the market could just say, okay, I've gone down far enough. I've gone down to the 261 and the 100. Now I'm going back up. You never know. And we're with the trend here, but now, it's what I would call oversold. It is oversold. Does that mean it can drop further? Absolutely. Will it consolidate here a little bit? Yes. So now's the time you really want to be watching this thing to see if you get a major move to the upside. If you do, hold on. Okay. Okay. Let me get into some discussion here on our weekly options, and let me go over real quick the TLT trade. TLT trade was again, this was one of these trades that I saw right here. We had a squeeze, and then it was squeezing overnight. And then it was squeezing early in the morning, and I jumped in here and jumped in right around here. Okay, two things were going on. When it came down here, it confirmed a double top. So I can go ahead and put in regression channel, or not a regression channel, but a Fibonacci retracement. And then it made a measured move right here, okay? And then towards the end of the day, it had pushed down below the 161. So, at this point in time, I had doubled my money. So at this point in time, it was like, I'm out. Here's the trade, okay? On Friday, right around 11 o'clock. It had a squeeze. And right around 11 o'clock, it made sense to go in one direction and one direction only, and that was a 108 put. And the 108 put was 52 cents. And, I got out towards the end of the day. I forget when it went down below here. I think I put my order in. That was 15 minutes before the close. But there's plenty of open interest, because this one had another week to go. I don't know that I would ever go that deep into the day of expiration, because you're the people that you're trying to get rid of it. There might not be any people left, but this one had plenty of open interest, I kind of waited till the end of the day, put this in, boom, it was gobbled up, and made 98, 100%. Now, I didn't want to hold it over the weekend, and lo and behold, it dropped, and then it opened Monday morning, and I'm thinking, well, I missed it. I missed the bunch. I could have maybe made some more. Well, let's just see here. Let's just see if the 261 would have went down there. Let's bring that 261 up. Bingo. Bingo. I chose not to stay with it and over the weekend. Let's see where the 261 was on this one. Bingo, bingo. I was okay with 100%. Could have I made 150, 200? Yes, but I had a lot going on this weekend. Graduation parties and everything else, and it was like, I don't want to be worried about this. So I took that and jumped out. If you would have held on, you would have made out quite nice. So then you look at this thing and you say, well, okay, let's assume you held on to that. And then what you're doing is you're looking here at a measured move to the upside. And then, you're back up to 260, you're saying, whoa, and then you get a retracement, and then it comes back up here and makes a measured move. Out. You got to get out at that point in time. And then it just continued on up. But it did go to that 261. I just didn't want to stay in there all weekend. So I jumped out of that. Okay? Okay. Let's just quickly take a look at some of our other stocks that we watch. EEM, we have no squeeze going on in EEM. FAS had an after-hours squeeze here, which I tend to ignore. Here it is. You could have made some money on there, guaranteed. That would have been a put. You could have just gone with a put on that one. So there was money to be made, but I never go ahead in there with an after-hours squeeze. I just don't like it. Okay, so now what I'd like to do on GDX is we're going to talk about the rhythm, getting into the rhythm. And what I have here, first of all, and this is really good because what SD was asking is basically, I don't know if you were peeking ahead at my charts, but this is what I want to talk about today. Exactly what you were saying. So this is what I want to talk about today. And David, I see you've got your hand up. Let me go ahead and unmute you before I get into there. David, how you doing today?
I'm doing great, Dale.
Good.
I had a question. TLT had a squeeze yesterday afternoon.
Yes.
And I got in 109. It was I got a 1-in call and a 108.
Okay.
And it hasn't done too much.
Right.
Yet.
Yeah, I looked at that, David, and I decided that it was when I looked at that, I decided that it was not long enough, it wasn't tight enough, and I basically ignored that. I'll come back to that after I'm done talking here. But David, while I've got you on here, I did pick up your son-in-law's book, Rory Vaden. Take the Stairs. Yes. 7 Steps to Achieving True Success. I would suggest this to anybody. Rory's a young dude, but boy, he's had some very good training, and he's referring to a lot of books that I've read in the past. Excellent. And I will summarize this for everybody, but I want this book in my library because just what I've read so far has been excellent, David. So thank you.
Thank you.
It's again, it's called "Take the Stairs: 7 Steps to Achieving True Success" by Rory Vaden. Okay, let's talk about measured moves and Fibonacci's. And the classic definition of an uptrend is higher lows confirmed by a higher high. That's the classic definition of an uptrend. Classic definition of a downtrend is lower highs confirmed by lower lows. It's a bearish measured move, a bullish measured move. One of the other things, you can look at Fibonacci retracements and see how far down that BC leg went. And if it didn't go 50%, then the probability is you're going to have a strong continuation to the upside. If it's greater than 50%, you might have a weak continuation. Same true on the bearish. So the AB is referred to as the reference range, the BC is referred to as the retracement, and the CD is the reaction range, and that's where we want to apply Fibonacci's only when it breaks through and makes a higher high and confirms that measured move. Okay, and basically what we're doing is we're taking a fib from A to B back down to C. Now, a fib of 100% is basically the same length of AB. Okay, so you're starting at C. So a fib of 100% would take this from this distance to this distance would be the same distance as AB. Okay. At 161, it would be 161% of this. And that's the way you do. That's what a fib is. And it's very easy to just go 1, B, C to get your possible locations for D. Okay. Now, when drawing the fibs, let's say you're moving in a staircase move, and this happens quite a bit. You can use AB, BC to predict H. You can use CD to DE to predict H. You can use EF to FG to predict H. Or there's my dominant measured move. It's got the most distance. Audio is restored. Okay. So this is the dominant measured move right here. It's wider. It's wider than this distance and this distance. So this is a measured move, a dominant measured move, and we can draw it from A to F, F to G to predict H. So basically we have 4 moves to predict H. And now what you want to do is you want to see a cluster that's around there, and that's how you use this. Now there's one other thing you can do. And when we're doing the weeklies, we're always putting on Strangles, but you can look at this and say, okay, if I've got measured move after measured move, I am in an uptrend. And I'm going to go ahead and use that And if it breaks through and makes a higher high, I'm going to go ahead and go in one direction. Just the opposite is true here. If we're right here and it's gone CD, DE, and now it's halfway right here and it turns to the downside, what you have there is a measured move to the downside. Okay? So you can use these, and it's like a channel. Where's my new high? Where's the low of the retracement? And if it goes in this direction, I'm breaking down with a measured move to the downside. If it continues on here, I'm going to the upside. Couple things you could do if you got a strangle is you could sell the call at this point, or you could wait and just buy a put, or you could buy a strangle and utilize this technology to see a profit down here and then wait for a reversal and go that way. All right. So what I want to do is utilize that. And John, I see you got your hand up, but let me finish up my little discussion here. I want to go in, and we'll do this more on Thursday for sure. But let's just take a look at the rhythm of the last 4 days in the marketplace. Okay, the first rhythm is here, where it went from here to here, and that was a measured move. It comes down to the very close to the 261, and then makes a measured move to the upside, to the 161, to a measured move to the downside, to the 261, to a measured move to the upside, to the 261, to a measured move to the downside, to the 161, a more dominant move, and the 127, to a move to the 261, to a move to the 261. Okay? The rhythm, you can put FIDs on here and look at measured moves and look and see the rhythm of the market. If we zero in a little bit closer here, you can see that right here we've got a move coming down. It goes past the double top 261 ferociously. So you look at the Fibonacci extension, and here's 261. You say, well, something might happen down here. Okay, so this now becomes the point. See, it came up here and it came down. If it would have gone through here, you can say, well, I've got a continuation. I've got a continuation to the downside. Where that's going to go, I don't know. But measured moves are going to tell me. The other thing is I can draw a line right here, because if it breaks through there, it has changed directions to the upside. Okay, so let's say you've got a strangle right around here. What do? Well, you could sell a put right here, or wait till it gets there and get a call. Same thing's true about going down here. This channel, it's got to break through to make a higher high or a lower low. Okay, that's the way you can follow the market. You just follow the market. Does it take some time to do that? Yeah, sure. Is it worth doing? Absolutely. How much time does it take? Well, 5-10 minutes once you get used to doing this, and now you've got a rhythm of the market. Down to the 281, up to the 161, down to the 261, up to the 261, down to a lower number here, but not all the way down, and then back up to the 261, back down to the 161 and the 100 of the dominant measured move. And now where are we? Where are we with gold? We have made a measured move to the upside. Gold is in a short-term uptrend. You always can look at these charts and determine where is, what trend are we in? Always. Always. John, I see you have your hand up. Let me unmute you here for a second. Sorry to keep you on hold so long, John. I just wanted to get through that. How you doing today?
I'm good.
Excellent.
You just read my mind, Dale, because I was going to ask you, why don't you apply what you've been talking about to GDX? And you did. So, yeah. So I appreciate that. I've got a trade on GDX at the present time, and I'm watching it. So on the basis of what you said, what does it look like? It looks like it's what, a downtrend?
Right now it's in. It just made a major move to the upside.
Upside.
Yeah.
Okay.
Absolutely. Absolutely.
All right.
Yep. Okay, John. Now
I just wanted to tell you that I bailed out of my bull put spread. It just, when it gets down to 850, 805.22, and my high strike is 805. That's too close. I just don't have guts for that.
Yeah. Which stock was that, John? Was that
that was Priceline.
Priceline? Okay. Okay.
I lost a little bit of money, but I got out of it at about 807.
Okay.
I just couldn't take it any longer.
Yeah.
But then it turned out in the afternoon it went back up to 813. So,
well, there you go. There you go.
If I'd stuck it out, I wouldn't have lost the cash I did.
Yeah, I know, but
I can live with that. Yeah, I can live with that.
I think what you did is excellent, because what you did required discipline, and it was like, okay, this is getting. I'm getting a little anxious about this trade right now, and I want to get out of this trade because there'll be another day, John.
Yes,
absolutely.
Exactly.
Yeah. Excellent.
Well, thank you, Dale.
You're welcome. You're welcome. Okay, excellent, excellent. All righty. David, I see you have your hand up again. Let me unmute you. I had trouble hearing you before. David, let's try it again. Are you there?
Okay. Yeah, I'm here.
Okay.
I'm here. Did you get filled in Stryker? I think you had.
Yes. Yes, I did. Yes, I did. And that's the next thing I wanted to talk about. Yeah, I'm in Stryker, and unfortunately I got in when Stryker was down about 22, and now it's up 14. But I'm okay with that. I'm okay with that.
Yeah, I just wanted to say too that Rory Vaden also gives speeches, and he's well paid. He was second in the world in Toastmasters.
Wow.
And which was the youngest guy ever to do that.
Wow.
So he's quite a speaker too.
Yeah, yeah. I haven't checked out his website yet or anything, but I would imagine he is a good speaker. And that training he got with Southwestern sounds like really good training. Did he have to have approval before he started talking about some of this stuff? Because I'm sure that's what they talk about too.
Yeah. I don't know about that. He's my son-in-law's stepbrother.
Okay.
And so I don't see him all the time, but I was real impressed with him. When I first met him, I thought he was like 14, and I said, this kid's going somewhere.
And he did.
He did, yeah. Yeah, he's like 31 now, and he's I'm sure a multi-millionaire now.
Yeah, excellent, excellent. And he hasn't taken the escalator.
No, he doesn't. That's a great thing to watch on the on his website. You can see he goes around the world, like the Empire State Building, to China, all around wherever they have the tallest buildings in the world. And he has his video camera, and he shows that most people, even when they're going to run up the stairs,
right,
will take the escalator instead of the stairs.
Pretty cool. Pretty cool. Thanks, David. Let me just remind everybody again, the name of the book is Take the Stairs by Rory Vaden, V-A-D-E-N. Okay, let's get into, and I'm gonna keep this up to date, and we'll talk about it more on Thursday for sure. You know, let me just go back here for a second, because I think I had done this when we had a squeeze. Let me see if I have that in here. Here it is. There it is. Let me blow this up. Okay. Okay, good deal. Coming down here, and it actually made a measured move here, and then again here, and we got a squeeze right here. If you would have taken the June 27.5 put, well, where would have you taken it? Well, you saw a measured move right here. You saw an after hours there was a measured move here, and then it went up, then it came down, and then it made a measured move right here, and then we had a squeeze, and then it made another measured move right here. You could have got the 27.5 put for 30 cents. 30 cents. And in 2 hours, you could have doubled your money. That's the explosion of a squeeze. You know, that's what I like to see in the FOMC. Sometimes we don't get that. Sometimes we get this stuff. Yikes. I don't know if you would have waited, right, you know, here you would have been able to get out of there at 56 cents. It probably would have only been worth, I don't know for a fact, but probably only about, 48 cents there, because you've got a lot of time, as it sits there and does that, just like it did with the FOMC meeting, the premium decays. But, that's, and I'm not advocating choosing a direction. What I'm advocating is, knowing the rhythm of the market. When you're in a strangle, you can watch it go in one direction, get out and watch it go in the other direction if you look for overbought, oversold conditions. Okay, let's go over some of our current positions, and let's go ahead and talk about Stryker right away. I wanted to get in Stryker if it was down around here, and you can see for sure it did. Stryker's up just a little bit today, but it is a bearish. That is a bearish candle on Stryker, even though the Dow Jones Industrial Average is up 120 points. Wow. So in my mind, that's pretty cool. So yes, indeed, I am in Stryker. If we just scan the board right here, we've got a put in Microsoft. There's not too much red here, but we've got it in Microsoft. Let's see, we've got it in DTV, and we've got a call in DFS. How nice is that? DuPont, one of the bellwether stocks of the Dow, is only up 19. Glaxo is only up a smidge. This Verizon is counterbalanced a little bit by this one. So all in all, as far as our directional trades, I think we're doing okay. I think we're down today. We're down today a little bit. But if you look at this, if you go down our board, the only thing that we are down on is the call position. Everything else is looking really good. And you can see with the RUT being strong today, let's just take a peek at what the bull put is worth. We got in at 90 cents, and let's just take a look at the bull put is worth $1.05. So I'm holding on to the bull put and watching what it's going to do in the next couple days, because we are right at some good support. Okay, all right. One other thing I wanted to do today, and I wanted to bring up Gerald Appel. Now, some of you have heard me talking about Gerald Appel before. He is the creator of the MACD. He's the creator of the MACD. He manages probably $1 billion at this point hedge fund. He's written the book Technical Analysis: Power Tools for the Active Investor. Let's see if I can make this any bigger. How am I going to make this bigger? I don't think I can. Let me maybe change the. There we go. There we go. There we go. All right. I like that. I'll go with that. Let me just go down through some of the burger dots, the info that I gleaned from his book. The first one: the news media tends to be the last to know and has an excuse for everything. The Wall Street Journal, Investors Business Daily, CNBC. If you listen to the news media, they will have an excuse for everything, and they will sometimes, I always do listen to CNBC in the morning because I like to see what the future markets are doing, and it kind of gets me ready for the day. Okay, it's time to get focused on the market. But I find it very interesting sometimes to listen to those guys, because they will give a reason for, let's say Apple drops a bunch. They will give a reason for Apple, and I will sit there and listen to it, and then I scratch my head and say, what did he just say? Sometimes it makes no sense, but there's the reason. So, I would suggest that everybody disengage from the market. You're the expert. You're the expert. You could probably tell that person the trend of Apple at this point in time where he has no idea, no clue. You're the expert. Believe in yourself. Believe in your talents, and do your own thing. Assume within yourself the responsibility for poor trades. I think I shared with you the other day a poor trade I made, and it was totally my fault, and I just was not disciplined, and just went against my rule of not getting whipsawed in the market between 9:30 and 10, and it happened. And I wrote that in my journal, and trust me, if you ask me, a year from now, 2 years from now, 5 years from now, what happened between 9:30 and 10 o'clock, I'll tell you exact trade, how much I lost, and that's what, when you put something like that in your journal and you take responsibility for it, you learn from that. You learn from that, and that's what this is all about. Keep your results to yourself. Boasting is not conducive to consistent performance. Think of those of you that listen to me on a regular basis, whether it be the blog or whether it be the webinar. I think most of you probably cannot tell whether I've made money that day or not, because one of the things I think is very important is to not be too high when you have a good day and not be too low when you have a bad day. It's all about staying focused and staying in the moment and not having wild emotional swings. That will not be good for consistent performance. Let your strongest position run and close out your weakest. Hello. The best timing tools tend to be profitable only a certain percent of the time. Now we know that. But those same timing tools, when they have winning trades, they're going to be larger than when they have losing trades. But you have to test it. You have to test it to make sure that is correct. It's better to miss a profit than take a loss. You'll see a lot of times when I talk about the weekly options, I'll say, yeah, okay, that one didn't look like a squeeze in my mind, and I didn't bother taking it. I'd rather miss a profit than take a loss, and I'm not comfortable with it, so I'm not going to take it. Trade with only capital you can comfortably risk. As a rule of thumb, we have our trade size rules that we can use and calculate. But as a rule of thumb, is if you've got a position on where you have any anxiety at all, and it's going to cause you to get out before you think you should get out, you have got too much at risk. Trade only with capital you can comfortably risk. One successful trade makes us feel good. 2 makes us feel pretty smart. 3 makes us feel like a genius. That's when the market gets us. That's when the market gets us. Don't try to outsmart the market. Trade according to your strategies, your style, and don't let the market swing you around, and don't think that because you've had 3 in a row that you are the king or queen. You're not. You're not. Stay within yourself. Stay within yourself. This next one, keep records. That's got to be number 1 in my hit parade. I talk about it all the time. Keep good records. Keep a journal. Make notes of your losing track transactions. Did you violate any rules? So you can always go back there and review that, and that's your continual learning. Not every losing trade is a mistake. The stock market at best is a game of probabilities. I can put on a trade that is just perfectly executed. The measured move is in the right direction. It's got a lot more room to run. It's just a perfect, well-executed trade. I get in there with a good fill, and all of a sudden the market turns on a dime and goes against me, and I get out. Hey, I expect that. That's part of trading. I didn't make a mistake in my execution. That's the important part. There's no need to be invested in the market at all times. Be patient and free to stand aside, waiting until matters clarify. These tips from his book, they really weren't tips. It was portions of the book that I gleaned. I like to go back and hit these every once in a while because this guy's a success. This guy's a success, and we can learn from people like this. Just like the book, Rory Vaden's book, we can learn from people like this. And occasionally, and I'm sorry for some of you that, have heard this before, but, there's nothing wrong with hearing it again because this is good stuff. This is good stuff. Okay. Let me just see if we got any final questions. Any final questions on anything? Okay. Now, you have some homework between now and Thursday. Your homework is think about what you're doing. and think about some areas that you're a little unclear on and you might have some questions. And what I'm going to do on Thursday is I'm going to start the webinar, and I'm not going to say a word for the first 5-10 minutes. I'm not going to say a word. So if nobody has any questions, we're just going to listen to silence, because I think questions are so important, and I want to make sure that I always have enough time to answer your questions. These are your webinars, you know, and SD, you know, I applaud you for some of the questions you have been asking. You know, SD's been with me for a long time, but we've never really talked. We've emailed back and forth, a bunch of emails, but until I heard his voice and until I heard some of his questions, I really didn't have a good idea where he's at. And some of his questions are very astute, and I think they're excellent and should be asked, because everybody can learn from those. So that's your homework between now and Thursday. And I don't want you to come in late, because if you come in late, I might pick on you. But please, you know, do yourself a favor. Think about where you're at, and any questions at all are fair game. And that's the way we're going to start Thursday's webinar. I hope everybody has you know, a good day today and tomorrow, and we'll come back on Thursday and have some more fun. Bye-bye now.